Here's the brutal truth that will save your trading account. 95% of retail traders lose money because they commit everything on their first entry. You see a breakout, your heart races, and you think, this is it, my big winner. So you load up with maximum conviction. Then you watch in horror as the market immediately reverses and stops you out for a devastating loss. This isn't just bad luck or poor timing. This is amateur behavior that destroys accounts systematically, month after month, year after year. Professionals operate with completely different psychology. They never commit their full position on the first entry. Instead, they use what Jesse Livermore called the 1% probe, risking only 1% of capital on initial entry to test the market's true intentions. This isn't just conservative position sizing. It's a complete psychological reframe that transforms you from a gambler betting on hope into a professional gathering market intelligence. Why does this work? Because professionals understand something amateurs don't. No entry is inherently safe. You make it safe through structure and discipline. The market doesn't care about your analysis or conviction. It only cares about proving you wrong at the worst possible moment. When you risk everything on first entry, your analytical abilities shut down the moment price moves against you. Fear floods your system. Every tick feels like a personal attack. You start making emotional decisions, moving stops, adding to losers, closing winners too early because you can't handle the heat. Picture this scenario with real numbers. You have a $50,000 account. Amateur, you sees a breakout and goes all in with $5,000. It fails immediately. You're down $1,500 and angry. Your month is ruined, your confidence shattered, and you're now susceptible to revenge trading. Professional you risks exactly 1%, just $500 to test the same level. It either confirms and you pyramid, or it fails and you pay $500 to learn. One approach changes your month, the other changes your career. The mathematics are profound. If you risk 10% per trade, just 5 consecutive losses wipe out nearly half your account. Recovery becomes mathematically impossible. But if you risk 1% per trade and maintain a 60% win rate with 2-to-1 reward to risk ratios, you'll compound at roughly 20% annually. Position sizing isn't just risk management, it's the difference between survival and extinction. Livermore understood this deeply. He didn't build over $100 million in 1929 currency through massive bets. He built it through thousands of small, intelligent probes. Each probe was designed to test market conditions with minimal risk while providing maximum intelligence. When probes succeeded, he earned the right to pyramid. When they failed, he paid small tuition fees for valuable market feedback. The probe methodology removes emotional pressure while providing real-time market intelligence. When you risk only 1%, you can't get hurt badly. When you can't get hurt badly, you think clearly. When you think clearly, you make better decisions. This creates a positive feedback loop that compounds over time. Your breathing slows. Your interpretation of the tape sharpens. You stop cheering for price and start listening to it. The psychological transformation runs deeper than risk management. Instead of trying to predict where prices will go, you're testing where they want to go. Instead of fighting the tape, you're reading it. Instead of imposing your will on the market, you're letting the market reveal its intentions to you. This shift from prediction to testing separates professionals from amateurs. The market is always right. Your job is to align with its direction, not argue with its verdict. Hidden within this technique are 4 critical filters that separate real moves from head fakes: price confirmation, volume behavior, volatility patterns, and time acceptance. Price confirmation means the market must reclaim and hold key levels cleanly, not just touch them with single ticks. Volume behavior requires participation. Real moves attract real money with expanding relative volume. Volatility patterns show contraction before expansion, energy building before release. Time acceptance means breakouts must sustain through specific windows, not just spike and fade. These filters work together to create a comprehensive market reading system. Your probe becomes a sophisticated sensor, testing market conditions across multiple dimensions simultaneously. You'll learn to structure stops just outside pivotal points with ATR calculations, ensuring your risk is consistent and proportional to market volatility. You'll master time stops, understanding that waiting is not inaction but an active position. The counterintuitive truth that destroys amateur accounts. Doing nothing will often be your best trade. Most traders focus on getting in. Professionals focus on getting out. They plan their exit before they plan their entry. They know their maximum loss before they know their potential profit. This risk-first mindset allows them to probe markets with confidence while amateurs gamble with hope. The 1% probe transforms you from a single-trade gambler into a market intelligence operation. You're constantly testing market conditions with minimal risk while positioning for maximum opportunity when conditions align. This is how generational wealth gets built, not through a few massive bets, but through thousands of intelligent, small-risk probes that compound over decades. The safest entry starts with the safest exit. The 1% probe isn't just a risk management tool, it's a sophisticated market-reading device that transforms chaos into actionable intelligence. When you risk only 1%, you can't get hurt badly. When you can't get hurt badly, your mind stays clear. Clarity beats conviction every time. Clear minds read the tape objectively. Convinced minds argue with it emotionally. This is where amateur and professional traders part ways forever. Amateurs crave certainty and shove maximum size through uncertain doors. Professionals embrace uncertainty and send scouts first to measure the battlefield before committing the army. In 1906, Jesse Livermore was stalking cotton with laser focus. Everything screamed bullish, perfect fundamentals with supply constraints, textbook technical setup with a clean base breakout, and euphoric sentiment across trading floors. Any amateur would have loaded up immediately with maximum conviction, certain this was their big winner. The setup looked so perfect that hesitation seemed foolish, even cowardly. But Livermore placed only his 1% probe position, risking a tiny fraction of his capital to test the market's true intentions, rather than betting on his analysis. The market moved against him slightly on the first day, then drifted sideways for 3 long weeks. Price chopped around his entry level without decisive movement in either direction. An amateur would have been stopped out within days, frustrated by lack of immediate gratification. Worse, many would have averaged down, adding to the losing position while convinced their analysis was correct, and the market was simply slow to recognize the obvious opportunity. This is how accounts get destroyed, not through single large losses, but through gradual accumulation of small mistakes compounded by emotional decision-making. But Livermore's probe was so small he felt zero emotional pressure. His breathing remained steady. His sleep was undisturbed. He could observe objectively how the market behaved around his entry price, studying volume patterns with scientific detachment, and analyzing price reactions to cotton-related news without the distortion of financial stress. During those 3 weeks, he noticed crucial details that would have been impossible to see objectively with a large position. Volume declined on upward probes, suggesting lack of institutional participation. Price rejected higher levels quickly but found support slowly, indicating distribution rather than accumulation. News that should have been bullish generated minimal response, while negative sentiment created immediate selling pressure. This reveals the probe's 3 critical functions that separate professionals from amateurs. First, it limits downside to almost nothing, removing the fear that clouds judgment and creates desperate decision-making. Your maximum loss is predetermined and trivial. Second, it provides real-time market feedback, turning your position into a sophisticated sensor that measures market conditions continuously. You're getting live data, not just historical charts. Third, crucially, it removes emotional pressure that clouds judgment, allowing you to interpret price action and volume behavior with scientific objectivity rather than emotional bias. Fear and greed are the twin enemies of rational decision-making, and the 1% probe effectively neutralizes their influence. Your probe becomes a market laboratory where you conduct controlled experiments with minimal risk. You're not predicting where price will go based on analysis or hope. You're testing where it wants to go based on actual market behavior. The market either confirms your idea immediately with decisive movement and expanding volume, or it teaches you that conditions aren't right through hesitation, rejection, or lack of follow-through. Both outcomes provide actionable intelligence that improves future decision-making. Failed probes are often more valuable than successful ones because they prevent catastrophic mistakes at minimal cost. The confirmation protocol requires specific market behavior before you add meaningful capital. Price must reclaim the pivotal point cleanly, hold above it with acceptance, then push with expanding range. Clean reclaim means decisive movement through the level with authority and expanding relative volume above 1.5 times average, not tentative single-tick penetrations that suggest uncertainty. Hold means sustained price action above the level without quick rejection wicks that indicate selling pressure or heavy offers capping every uptick. Push means range expansion in your favor with increasing momentum that suggests institutional participation and genuine accumulation rather than temporary squeezes. Use the second mouse mindset that serves professionals across all markets. Let the first mouse spring the trap. You enter on the reclaim or pullback hold, not the initial stab through resistance. The first buyers often get trapped by false breakouts and stop hunting algorithms designed to shake out weak hands. The second wave of buyers, those who enter after confirmation, catch the real moves with superior risk-reward profiles. This patience transforms gambling into business by requiring market confirmation before capital commitment. Amateur traders try to impose their will on the market through conviction and position size. Professional traders understand the market is always right and their job is to align with its direction, not argue with its verdict. Enter on acceptance, not on impact. The market must prove it wants to go your direction before you commit meaningful capital. Livermore lived at the pivotal point-specific price levels where the market tips its hand and reveals true intentions through decisive action rather than ambiguous noise. These aren't mystical indicators conjured from complex algorithms, but precise levels visible to any trained eye. Prior significant highs and lows that marked important turning points. Well-defined base edges where accumulation or distribution occurred over weeks or months. Gap reclaims where price returns to fill overnight or weekend. Voids and clean trendline breaks, where established patterns finally surrender to new directional forces. Your 1% probe tests the market's conviction at these critical junctures, measuring whether institutional money backs the move or retail enthusiasm drives temporary spikes that quickly fade into disappointment and losses. But not all pivotal points are created equal. And this is where amateur traders get destroyed, while professionals build fortunes. The difference lies in systematic filtering that separates real moves from head fakes through 4 critical dimensions. Price behavior that reveals true participant intentions, volume confirmation that shows money backing the move, volatility patterns that indicate energy building and releasing in natural cycles, and time acceptance that distinguishes genuine institutional moves from algorithmic noise and emotional reactions. These filters work together as gatekeepers, ensuring only the most robust setups earn your capital commitment. Amateurs see a level and bet immediately. Professionals interrogate the level with multiple confirmations before risking meaningful money. Filter 1 demands specific price behavior that reveals market structure and participant psychology. Require clean reclaim and acceptance above the pivotal point, not tentative single-tick penetrations that suggest uncertainty or lack of conviction. The breakout must be decisive with authority and expanding range, showing buyers absorbing all available supply rather than struggling against heavy offers. Watch carefully for upper wicks appearing immediately after breakouts. These are classic distribution signatures indicating smart money selling into strength while retail money chases the move. Heavy offers capping every uptick reveal sellers stepping in at higher prices, while clean breaks with minimal resistance show genuine demand overwhelming supply. Your probe can sit idle indefinitely when price behavior fails these tests. Patience isn't inaction but active waiting for proper market conditions to align with your requirements. Amateur traders mistake any movement above a level for confirmation, then wonder why their positions immediately reverse. Professional traders understand that markets must live above pivotal points, not just visit them. Clean reclaims show institutional participation and genuine supply-demand imbalances. Messy breaks with multiple false starts suggest algorithmic games and stop hunting rather than legitimate directional conviction. The market either wants to go or it doesn't. Your job is reading its true intentions through price action, not imposing your hopes on ambiguous signals. Filter 2 demands volume confirmation, proving money backs the move rather than just retail enthusiasm or programmatic manipulation. A push through the pivot with 150 to 200% of average volume is money-backed, and suggests institutional participation rather than retail games played on thin volume. Use relative volume intraday readings above 1.5 times average near the pivotal level signal, genuine institutional interest, rather than random fluctuations that characterize most intraday noise. Even better, watch volume on pullbacks after breakouts. Weak volume on retracements shows controlled supply and suggests smart money isn't selling into the move, but actually accumulating on any weakness that develops. Volume patterns reveal participant behavior that price alone cannot show with sufficient clarity. High volume on breakouts, combined with low volume on pullbacks, suggests strong hands buying, while weak hands aren't selling the ideal setup for sustained moves. Low volume on breakouts indicates lack of institutional interest and dramatically higher probability of failure within days or hours. Volume spikes without corresponding price movement often signal distribution or accumulation depending on context and prior action. Expanding volume on continuation moves confirms trend strength and suggests more upside potential, while declining volume on continuation warns of potential exhaustion as fewer participants support the move. Filter 3 focuses on volatility patterns that reveal energy building and releasing in natural market cycles that repeat across all timeframes. Look for contraction before expansion, measured through average true range or intraday range, shrinking 30 to 50% into the pivotal point over several periods. This contraction shows energy building like a coiled spring, with participants positioning quietly for the next major directional move. Then demand expansion when price breaks through the level, showing that compressed energy releasing in sustained directional movement, rather than continued sideways grinding that goes nowhere. Expansion without prior contraction usually means noise rather than signal, suggesting random volatility spikes rather than directional conviction backed by institutional positioning. Volatility compression creates the energy necessary for sustained directional moves that produce meaningful profits. Markets breathe through natural cycles of expansion and contraction, and the most powerful moves consistently emerge from periods of tight consolidation where volatility compresses significantly below normal levels. This compression forces participants to make positioning decisions, creating the underlying tension necessary for explosive moves when the consolidation pattern finally resolves in either direction. Moves that emerge without prior compression often lack the energy to sustain themselves and typically fail quickly as the initial enthusiasm fades without follow-through. Filter 4 requires time acceptance that distinguishes genuine institutional moves from opening noise and algorithmic manipulation designed to harvest stops and create false signals. Breakouts in the first 15 minutes are often fireworks that fizzle as overnight emotions get flushed, and rational institutional analysis returns to dominate price action. Professionals prefer confirmations in the 10 to 11:30 window, when institutional flow begins in earnest, or during power hour close, when real money makes final positioning decisions for overnight or weekend exposure. For swing trades, weekly closes beat daily noise by filtering out intraday manipulation and focusing on longer-term directional bias that institutional money creates through sustained positioning over multiple sessions. In October 1907, Livermore watched Union Pacific flash a seemingly perfect technical setup after building a tidy base with strong fundamentals supporting higher prices. His 1% probe immediately failed, hitting his tight stop for a modest $200 loss within hours of entry. Any amateur would have been frustrated by the quick failure and tempted to re-enter or find another similar setup to recover the loss. But Livermore read the failure as crucial market intelligence revealing deteriorating conditions beneath the surface. 3 days later, the entire market crashed 40% in the panic of 1907. That small probe loss saved him from a potential $50,000 disaster by revealing market weakness that fundamental and technical analysis couldn't detect. Failed probes are more valuable than successful ones because they prevent catastrophic mistakes at minimal cost, while providing real-time intelligence about changing market conditions that no amount of analysis can reveal in advance. Now for the exact mechanical rules that transform the 1% probe from abstract concept to profitable reality that compounds wealth over decades. Mathematics removes emotion from the equation and creates repeatable processes that survive market cycles. Personal psychology and the inevitable losing streaks that destroy undisciplined traders. Amateur traders operate on conviction and hope, adjusting their risk based on how confident they feel about each setup. Professional traders operate on mathematical precision, maintaining consistent risk regardless of conviction level, because they understand that feeling confident and being right are completely unrelated in financial markets. This fundamental difference in approach determines who builds generational wealth and who joins the 95% of traders who lose money consistently over time. Step 1. Calculate your sacred number. The foundation of professional trading begins with calculating your sacred number before you even open a chart or analyze a single setup. If you have a $50,000 account, your maximum probe loss is exactly $500, not $501 when the setup looks extra compelling, not $750 because your analysis seems bulletproof. This number is mathematically inviolate and represents the maximum amount you're willing to lose on any single probe regardless of conviction level, fundamental analysis, or technical setup quality. Calculate this number when markets are closed and your mind is clear. Then honor it religiously when markets are open and emotions run high. The psychology behind the sacred number runs deeper than simple risk management. It forces you to acknowledge that you will be wrong frequently, sometimes consecutively, and that your survival depends on keeping individual losses small enough that you can afford to be wrong many times while still maintaining enough capital to catch the winners that pay for all the losers plus generate net profits. This pre-calculation removes the psychological burden of loss aversion. You know, before you enter, the maximum pain you can experience, and because it represents only 1% of your account, that pain becomes negligible. This freedom from fear allows you to observe market behavior dispassionately, a luxury that amateurs, constantly worried about blowing up their accounts, can never afford. Step 2. Find your invalidation level with ATR. Cushioning your invalidation level must be determined by market structure, not by your desired position size or risk tolerance. Mark the specific point where your trading idea is definitively wrong, usually just beyond the pivotal point with an average true range cushion that accounts for normal market volatility. If the 14-period ATR is $2, you wouldn't place your stop directly at the pivotal point. Instead, place it 70 cents to $1, 20 cents beyond the invalidation level, typically between 0.35 and 0.6 times the ATR, to clear realistic noise without giving the market too much room to work against you. Never hide stops inside the battle zone where normal market fluctuations will trigger premature exits. Your stop must be placed at a logical structural level where being hit means the market is definitively telling you that your analysis was incorrect. This discipline prevents the amateur tendency to constantly move stops lower, hoping for miraculous reversals that rarely materialize. The market doesn't care about your account size or risk preferences. It only cares about supply and demand dynamics that create genuine support and resistance levels through actual trading activity. Step 3. Mathematical position sizing. Calculate position size using a precise formula that removes guesswork and emotional decision-making from the process. Risk per share equals entry price minus stop price, creating the actual dollar amount you'll lose per share if stopped out. Total shares equal your sacred dollar risk divided by risk per share, ensuring your maximum loss stays within predetermined parameters regardless of stock price or volatility. Here's the exact calculation. Entry at $48 on breakout through $47.80. Stop at $46.80 to clear the base structure with ATR cushioning. Risk per share equals $1.20. Position size calculation. $500 divided by $1.20 equals 416 shares. Round to 400 shares for simplicity, and to ensure you don't exceed risk parameters through fractional complications. Position size equals sacred dollar risk per share equals $500. $1.2 equals 416 shares, rounded to 400. Position size equals risk per share. Sacred dollar risk equals $1.20. $500 equals 416 shares, rounded to 400. This mathematical approach eliminates the amateur tendency to buy round lots like 100 or 500 shares, regardless of risk per share, which creates inconsistent risk exposure that can destroy accounts when high-priced volatile stocks generate massive losses relative to account size. Professional position sizing ensures consistent risk exposure across all trades, regardless of stock price, volatility, or personal conviction about setup quality. Step 4. Implement time filters. Price must confirm your thesis within predetermined windows, or you flatten the position immediately. For intraday positions, allow 30 to 90 minutes for confirmation. For swing trades, require 1 to 2 daily closes above the pivotal level. Waiting is indeed a position, but stale trades rot like old fruit and tie up capital that could be deployed more productively elsewhere. Every minute your capital remains committed to an underperforming trade, it incurs opportunity cost by preventing you from taking advantage of fresh opportunities with better probability profiles. Time filters force you to acknowledge when market conditions don't align with your analysis rather than hoping for eventual vindication that rarely comes. Markets that don't confirm quickly often don't confirm at all, and professional traders cut these positions quickly to preserve capital for better opportunities rather than hoping for miraculous reversals that usually don't materialize. Step 5. Step 5. Honor the heat cap. Keep total open risk at or below 1% of account value across all positions. Even if individual probes are properly sized, you must ensure your aggregate risk exposure doesn't exceed predetermined limits. If slippage during entry or unexpected gaps expand your initial risk beyond 1.2%, exit immediately and reassess. This is a hard line that cannot be negotiated. You're paying tuition for market education and intelligence gathering, not gambling on miraculous outcomes that violate your predetermined risk management rules. Advanced implementation considerations. Use bracket orders to eliminate hesitation and slippage drift during execution. Send entry, stop, and first target simultaneously, then manage from strength rather than fear. Practice this sequence in market replay until your fingers execute without conscious thought. Build a pre-trade checklist and speak it aloud. Sacred number set, invalidation level marked, ATR cushion measured, position size computed, time window defined, heat cap verified, order type selected, and correlation risk assessed. If any element is unchecked, you do not trade. Maintain detailed records of each probe, including symbol, setup type, pivot source, ATR reading, relative volume at trigger, time of day, spread width, confirmation result, and R multiple outcome. Review these logs weekly to identify patterns. Some sectors only move when index RVOL exceeds 1.5 times average. Some timeframes consistently outperform others for your style. Trim what doesn't pay, and press what does through systematic analysis rather than gut feelings. Real-world application. Consider a professional trader probing an earnings gap reclaim setup. He calculates his sacred number as $500 based on his account size. He identifies the invalidation level with proper ATR cushioning, determining his risk per share is $1. This mathematical precision means he can purchase exactly 500 shares. He enters the probe and price hesitates initially, creating doubt about the setup's viability. Then price pushes higher with expanding relative volume above 1.5 times average, confirming institutional participation. Critically, he doesn't add to the position immediately despite the confirmation. He waits until the position shows positive half-R profit, meaning he's already made half his initial risk amount before even considering additional size. Had the probe failed instead, his loss would have stayed capped at the predetermined $500 amount. He bought market information first through the small probe, then earned the right to buy position size second, after the market confirmed his analysis through decisive price action and volume behavior. The professional edge. This mathematical precision in risk management and position sizing separates professional traders who compound wealth consistently from gamblers who experience wild equity swings and eventual account destruction through emotional decision-making. Rules remove regrets, and small losses become tuition, while large losses mean expulsion from the game. When you master this mechanical implementation, the tape transforms from predator to partner, providing consistent feedback that improves your decision-making over thousands of trades. The compound effect of this disciplined approach creates generational wealth not through heroic trades or market predictions, but through the systematic application of mathematical principles that remove emotion from the equation and replace hope with process. Every successful professional trader understands this fundamental truth. Consistency beats conviction every time, and mathematics beats emotions in every market cycle. Once your 1% probe confirms and moves decisively in your favor, you have earned the right to build a larger position through systematic pyramiding that transforms small intelligence-gathering operations into significant wealth-building campaigns. This is where most traders commit their next critical error. They add too much, too fast, destroying the very safety they created with the initial probe. The psychological trap is seductive. Your small position is working. Confidence builds, and greed whispers that bigger size means bigger profits. Amateur traders succumb to this voice and load up aggressively, transforming a disciplined probe into a reckless gamble that often ends in disaster when markets inevitably test their resolve. The professional's inverted psychology Jesse Livermore operated with a strict pyramiding protocol that governed every addition to winning positions throughout his legendary career. His cardinal rule: you only add to winning positions, never losing ones. This seems obvious, yet 90% of retail traders violate this principle by averaging down on losing positions, hoping to reduce their average cost while the market continues proving them wrong. Each addition must be smaller than the previous one, creating a pyramid structure that gets more conservative as total risk increases rather than more aggressive as profits accumulate. This inverted approach feels counterintuitive to amateur traders who want to press their luck when winning, but it represents the mathematical foundation of professional position building that compounds wealth over decades while protecting against catastrophic losses. The psychology runs deeper than simple risk management. When you build positions correctly, your largest capital commitment occurs at the most confirmed price levels, while your smallest commitment occurs at the least confirmed levels. This creates natural protection against adverse moves because your average entry price remains significantly below current market price, providing substantial cushion against volatility. Amateur traders do the opposite. They commit maximum size at unconfirmed levels and minimal size at confirmed levels, creating top-heavy structures that collapse under their own weight during normal market fluctuations. Mathematical framework and precise implementation. The mathematics are precise and non-negotiable, removing emotion and guesswork from scaling decisions. Your first addition occurs at positive half R, meaning half your initial risk amount in profit. Your second addition occurs at positive 1R, meaning your full initial risk amount in profit. If your probe risked $1.20 per share, you add after 60 cents profit per share, then after $1.20 profit per share, never earlier, regardless of how compelling the setup appears or how strong your conviction becomes. The market must pay you before you pay more. This principle eliminates hope-based additions and ensures every scaling decision is backed by market validation rather than analytical confidence. Addition triggers. Addition triggers. First add, entry price plus 0, 5R. First add, entry price plus 0, 5R. Second add, entry price plus 1, 0R. Second add, entry price plus 1, 0R, where R equals initial risk per share. Where R equals initial risk per share, size down each addition systematically using the decreasing ratio structure. Your initial probe represents 1 to 100% of your base unit. Your first addition should be 70% of that base unit. Your second addition should be 50% of the base unit. Using our previous example of 400 shares for the initial probe, your first addition would be 280 shares, and your second addition would be 200 shares, creating a total position of 880 shares. Position sizing pyramid, text initial probe, keturi shimtai text shares, vienas kablelis nullis nullis. Text first add, 400 times 0.7 equals 280. Text shares, 0.7. Text second add, 400 times 0.5 equals 200. Text shares, 0.5, 880. Text shares. This structure prevents dangerous top-heavy positions where the largest capital commitment occurs at the highest prices, making positions vulnerable to minor pullbacks. The pyramid ensures your average entry price remains substantially lower than current market price, providing mathematical protection against normal market volatility while allowing you to ride extended trends with confidence. Critical stop management protocol. Stop management must accompany each addition to maintain risk discipline throughout the position building process. After your first addition, calculate your new composite average price and trail your stop to ensure total portfolio heat for this position remains below 1% of account value. This requires precise calculation. If your average price after the first addition is $48.40 and your structural stop sits at $46.80 with proper ATR cushioning, your total dollar risk equals 680 shares times $1.60, or $1,088. If this exceeds 1% of your account, you must either move your stop closer or reduce position size to maintain risk discipline. Composite risk calculation. Composite risk calculation. Total shares times average price stop price is less than or equal to 1% of account. Total shares times average price stop price is less than or equal to 1% of account. After your second addition, move the entire position stop to break even or slight profit on your composite average price. Your worst case outcome transforms from potential loss to guaranteed flat or small profit, eliminating the possibility of turning a winner into a loser through poor exit execution. This psychological shift from potential loss to guaranteed non-loss is transformative, freeing your mind to focus on trend management rather than worrying about giving back profits. Historical validation. Livermore's wheat campaign. In 1908, Livermore's wheat trade demonstrates the power of disciplined pyramiding over extended time periods. He initiated with a modest $500 risk probe on a technical breakout that initially moved in his favor. Through systematic pyramiding, adding 75%, then 50% of original size at predetermined profit levels, he built the position into a $50,000 winner over 6 months. Each addition was triggered by sustained market strength demonstrated through continued price advancement and expanding volume confirmation, not hope or analytical conviction about future direction. The key insight: each addition was earned through market behavior, not imposed through trader desire. When price reached his half-hour target with expanding relative volume and clean price action, he added the first increment. When price reached his 1-hour target with continued institutional participation, he added the second increment. Between additions, he remained patient, allowing the market to prove its intentions, rather than forcing additional size based on fundamental or technical analysis. This market-driven approach allowed him to capture a massive move while maintaining strict risk control throughout the entire campaign. Defense protocol and risk management pyramiding requires constant vigilance and willingness to abort the process when market conditions deteriorate. If time windows fail, meaning price stops advancing within expected time frames, freeze all additions immediately. If tape filters deteriorate, such as relative volume collapsing below 1.0 or bid-ask spreads widening significantly beyond normal ranges, consider cutting back to core position size. Never allow total heat to exceed 1% of account value after pyramiding, even if this means reducing position size below optimal levels. Monitor correlation risk as positions grow larger. Multiple positions in related sectors or similar market capitalizations can create hidden concentration risk that violates overall portfolio heat limits. Use position sizing spreadsheets to track aggregate risk across all open positions, ensuring you never exceed predetermined limits regardless of how compelling individual setups appear. Professional traders often discover their best ideas cluster in similar market segments, creating dangerous concentration that must be managed through position sizing rather than setup selection. Exit ladder strategy. Implement a systematic exit strategy that captures profits while allowing continued upside participation. Take profits on 1/3 of the total position at positive 2R, securing gains that exceed your initial risk by a factor of 6 when accounting for pyramided size. Trail stops under higher lows using ATR-based distances that adjust to changing volatility conditions, typically 0.5 to 1.0 times the 14-period ATR below recent swing lows. Hold remaining runners to measured moves based on the initial base range or technical targets derived from classical chart patterns. Let the tape evict you through systematic stop-loss hits, rather than emotions through premature profit-taking decisions. This discipline ensures you capture the full extent of winning moves, rather than cutting them short due to fear of giving back profits. The most profitable trades often feel uncomfortable to hold because they advance beyond logical expectations, and only systematic exit rules can capture these outlier moves that generate the bulk of professional trading profits. Implementation checklist. Before adding to any position, verify these conditions. Initial probe showing positive half-hour or 1-hour profit, a relative volume maintaining above 1.5 times average, price action remaining clean without distribution signatures, time windows being honored with continued advancement, and total portfolio heat remaining below 1% after the addition. If any condition fails, freeze additions and reassess market conditions. The pyramiding protocol transforms small probes into significant winners while maintaining the risk discipline that separates professionals from amateurs. Master this technique and discover that position building, not position taking, creates generational wealth through systematic amplification of winning trades, while strict loss control prevents any single trade from damaging long-term compound growth trajectories. This is how you build a staircase of wealth, rather than gambling on single heroic trades that rarely materialize as hoped. The master level of the 1% probe technique involves running multiple probes simultaneously across different sectors and time frames to read overall market conditions with institutional precision. This isn't about trading more frequently or increasing your activity level. It's about trading smarter, by using your probes as sophisticated market sensors that provide real-time intelligence about broad market structure and underlying institutional flow that individual setups cannot reveal. Amateur traders focus obsessively on single trades, convinced that one perfect setup will unlock their fortune. Professional traders orchestrate multiple small probes to understand the market's overall personality, then adjust their aggression levels based on systematic feedback rather than emotional reactions to individual outcomes. Livermore never relied on a single probe to make major portfolio decisions during critical market periods. He would systematically identify 3 to 5 potential setups across different sectors: rails, industrials, commodities, financials, and consumer goods, entering 1% probes on all candidates within the same time frame to create a comprehensive market sampling system. Think of each probe as a weather balloon transmitting data from different atmospheric layers. One balloon tells you local conditions. 5 balloons reveal the entire weather system. If most probes succeeded with clean confirmations and sustained follow-through, it signaled strong trending conditions where he could pyramid aggressively and initiate new positions with higher conviction. If most failed despite solid technical setups, it warned of choppy conditions or impending directional changes requiring defensive positioning. The mathematics are precise. With a $50,000 account, risk 0.6% per probe across 5 names, $300 each, keeping total heat at $1,500, or 3% maximum. You learn fast, lose small, and let breadth guide aggression. Build a traffic light dashboard. 3 greens out of 5 means trending conditions. Press harder. 2 or fewer means defensive mode. Reduce size. Your job isn't predicting the next candle, it's scoring the environment and adjusting position size to match current regime conditions. In September 1929, Livermore executed one of history's most sophisticated market intelligence operations. Surface conditions looked bullish, headlines glowed, leaders pushed to new highs, sentiment remained euphoric across trading floors. But Livermore trusted the tape over headlines. He ran bullish probes across industrials, rails, banking, and commodity stocks, each showing apparently perfect technical setups with strong fundamentals. One by one, they failed quietly, not with dramatic reversals, but with weak acceptance above breakouts, volume that wouldn't sustain, and midday fades that should have held strong. Amateur traders would have grown frustrated and doubled down, convinced their analysis was correct. Livermore read the synchronized failure as the market's true message. The collective rejection across uncorrelated sectors revealed underlying weakness beneath surface strength that no individual stock analysis could detect. Instead of fighting the message, he immediately switched to bearish probes, testing short setups across the same sectors. These succeeded immediately with decisive price action and expanding volume, confirming the market's desire to decline despite bullish appearances. Within weeks, the crash began, and his positioned shorts generated over $100 million in profits. This massive success resulted not from predicting the crash through fundamental analysis, but from reading market behavior through systematic probe methodology that revealed institutional distribution invisible to conventional analysis. Advanced correlation analysis forms the foundation of professional multiple probe methodology. When probes across genuinely uncorrelated sectors, technology and utilities, growth and value, commodities and financials all behave similarly with consistent success or failure patterns, it reveals broad market forces transcending individual sector dynamics. These forces represent institutional flow patterns, policy impacts, or economic shifts, affecting all risk assets similarly. When probes diverge significantly, with some sectors succeeding while others fail, it suggests sector-specific dynamics rather than broad market forces, often signaling rotation patterns where institutional money flows from declining sectors into advancing ones. Stack timeframes to refine intelligence quality. Run microprobes intraday to sense immediate tone, then graduate to swing probes when conditions align across multiple time horizons. A 5-minute reclaim that holds into the first hour provides initial confirmation. A daily close above the same pivot with expanding range offers stronger validation. A weekly close that encompasses both delivers maximum confidence. Demand alignment before pressing size. 2 timeframes to engage, 3 to pyramid aggressively. Protocol for multiple probes requires strict discipline. Never exceed 3 to 5% total account risk across all simultaneous probes, regardless of setup quality or conviction level. Maintain detailed probe ledgers capturing setup type, sector, time frame, pivotal point source, relative volume at trigger, time to confirmation, and outcome in R multiples. Review weekly to compute rolling success rates, median confirmation times, and outcome distributions by sector and market condition. This systematic data collection transforms intuitive trading into scientific methodology based on statistical evidence rather than emotional reactions. Use probe results to adjust your overall market stance dynamically. When success rates exceed 60% across diverse sectors, increase position sizes, pyramid existing winners aggressively, and maintain higher market exposure. When success rates fall below 40%, cut position sizes in half, tighten stops, take profits quickly, and raise cash levels. This removes emotional bias from stance decisions, replacing gut feelings with objective feedback from actual market behavior. The 1% probe transforms you from a single trade gambler into a market intelligence operation. You stop arguing with price and start interrogating it systematically. Multiple simultaneous scouts across the market tell you whether conditions favor trending or mean reversion, offense or defense. This is how Livermore built generational wealth, not through heroic predictions but through thousands of intelligent, small-risk probes that provided continuous market intelligence while compounding consistently over decades. The 1% probe isn't about finding perfect entries. It's about creating safe ones through disciplined process. Calculate 1% risk first. Always. Find pivotal points where the market tips its hand. Enter small to test, not to bet. Demand confirmation through price acceptance, volume participation, volatility expansion, and time validation. Cut losses fast. Pyramid only on strength, and let failed probes save you from disasters while successful ones build generational wealth. If you mastered this methodology, the next lesson on professional exit strategies will complete your transformation from amateur gambler to professional trader.